from insurance rates to climate change, and why those of us who are not homeowners should care. In the past, obtaining or maintaining homeowners insurance was relatively easy. However, as climate change intensifies, the frequency and severity of extreme weather, insurers, particularly in regions most affected by floods and fires, are raising their premiums or withdrawing entirely, affecting the affordability and availability of home and fire insurance. This crisis in the homeowners insurance market is not something that only homeowners need to care about. The spillover effect is likely to be felt in housing and mortgage markets and local economies. It is also a sign of the alarming increase in the number and severity of weather and climate disasters in the United States, which broke records in frequency and cost last year and is expected to do the same this year. Our guests will examine the issue, explain how it affects people's lives, and discuss possible solutions in which the insurance industry, government, and ordinary people play important roles. Our panel includes Vicky Kilgore, Assistant Vice President of the Insurance Research Council, Jordan Haedtler, Climate Financial Strategist with the Sunrise Project and Climate Cabinet, Carol Kousky, Associate Vice President for Economics and Policy at the Environmental Defense Fund, and Ricardo Lara, California Insurance Commissioner. Please, all of you, speak slowly for our interpreters in Spanish, Mandarin, and Korean. Reporters, we have, as always, our chat for questions. We expect a discussion on this today, so please have your questions ready and enter them in the chat. So we will begin with Vicky Kilgore, who will give us some data that illustrates the crisis of homeowners insurance across the country. Vicky, the stage is yours.
Thank you, Pilar, Sandy, and EMS for hosting today. Let's get my screen shared here. Is that working for everyone?
It looks good.
All right, thank you. And feel free to tell me if I'm not going slowly enough. Do a virtual throw a stone at me or something. Well, again, thank you for the opportunity to speak with you today on this issue alongside this distinguished panel. Very briefly, let me, well, just a moment and tell you very briefly, there we go, about who the Insurance Research Council is. We are a nonprofit organization that looks at public policy issues that impact the property casualty insurance industry. We are a division of the Institutes. We were founded back in 1977. We are not a lobbying group, but we do address public policy issues. Today, I'm going to be sharing a little bit about one of our recent studies, which is on homeowners insurance affordability. The goals of this research were to define a measure of insurance affordability that would enable us to make comparisons over time and across states. We also wanted to identify key cost drivers that account for those differences. So first, to define affordability, we don't look at insurance prices, such as what you might find on a comparative rating site, Zebra, or the other places where you can just look up a rate. We think it is more accurate to look at what homeowners actually spend and then compare that to their financial means. How we do that is first to look at homeowners insurance premiums paid. That we get this number from the National Association of Insurance Commissioners. They put out this publication with this very long title shown here, where they look at premiums paid. So we get this number over time, countrywide and by state, for what the average expenditures on homeowners insurance was for a specific year. One caveat here is that the data is only current through 2021. And we realize that the market has changed since then. A lot of the significant rate increases we've seen have come since then. So we do plan on updating this research as soon as a newer number comes out from an AIC. We take this expenditure number and then divide it by median household income. So that gives us a measure, which we call the affordability index, that looks at the share of a household's income that will go toward paying for homeowners insurance. So this first chart, excuse me, looks at the average expenditure number that I was just describing. And as you can see, this red line has shown considerable growth over the past 20 years. If we compare that to growth in median household income, you see that expenditure growth has outpaced income growth by a considerable margin. So then when we look at the ratio of these two numbers, or our affordability index, we see that that ratio has gone from 1.27 in 2001 to 1.99% in 2021. That increased share of income that goes to pay for homeowners insurance shows that homeowners insurance is less affordable than it was. Again, with the caveat of we know that things have changed since 2021, and we predict that that number will go up above 2% when we get updated data. So we use this affordability index, as I said, to look at variations across states. And you will see a wide variation. The most affordable state in 2021, which is to the far left, was Utah. And their homeowners spent less than 1% of their income on homeowners insurance. In contrast, the expenditure share in the least affordable state, which was Florida in 2021, was more than 4 times higher. So in Florida, it was more than 4% of a household's income. Other states on the less affordable range you see here were Louisiana, Mississippi, Oklahoma, and Texas. And beyond just looking at which states were more or less affordable, we really strive to get some explanation as to why that is. In order to explain differences in affordability or optimally look for ways to improve affordability, all of these efforts must be rooted in an understanding of what drives the cost of insurance. So we identified 8 key factors that drive the variations that we have seen across the states in affordability. These are all not independent. Obviously, they are related, but I will talk through very briefly. You'll see at the top, not surprisingly, that natural hazards is right there at the top of the list, especially weather hazards. So we gathered data from the Federal Emergency Management Agency to look at weather risks, which would be hurricanes, hail, windstorms, and then other natural hazards, which is most notably wildfires. We also looked at claim data that comes from one of our reports. So we look at claim frequency, which means how often claims are filed, and look at catastrophe claims, which are identified as a widespread event, as opposed to non-catastrophe claims, which are more isolated, such as like an electrical fire or things that don't impact a large number of homes. We also look at claim severity, which is the average payment per claim, and both catastrophe and non-catastrophe. And then finally, we look at a couple of measures that are related to claim settlement, such as the expense index, which is investigation or legal expenses, or the percentage of claims that involve litigation. We put all these together into a visual representation that we call our cost driver matrix that just lists the states from most affordable to least affordable at the bottom, and then color codes everything to how favorable or unfavorable these factors are. So if you look at Florida, for example, our least affordable state, you will see the red going all the way across. And most notably, the weather hazard risk and the expense and in litigation index are quite red for Florida. And we can only hope that as the changes that they have made in that state may improve some of that on those expense and litigation fronts, but the natural hazard risks is obviously something completely different. We find this useful for explaining in a given state what might be a cost factor in the state versus another, and just an overall visual representation. So that is a very quick look through a summary of this report. I do have contact information here for me, as well as an address for the IRC in general, or specifically to more information about this particular report.
Thank you, Vicky. Are you done?
Yes, I'd be happy to take any questions, yes.
Hi, thank you so much for this very graphic and very clear set of data. We have this presentation. We will send it to you, reporters. I had a question for you, Vicky. What does this mean for the average homeowner across the country and in states that are most affected? In terms of, I've read horror stories of people's homeowners insurance jumping from, like, I don't know, like $1,000 to $6,000, things like that. So explain to us if you can.
Well, certainly, because we are looking at a countrywide data and then statewide data, we cannot fully address what individual homeowners may be facing and strategies that they may be able to use to address their particular cost situations. Certainly, we have also heard the same stories that you're referring to. And to the extent where we see the importance of weather, I think one of the reports that this is showing, it shouldn't be surprising to anyone, but just how important that is. I think individuals and policymakers need to think about ways to how we can adapt to those situations, whether it's zoning or building code, ways to encourage homeowners to mitigate the damage that may occur to their homes.
Okay, great. Thank you. Thank you, Vicky. Please stay around. We're going to move on to the next speaker so we can start tying all of this together. What does this mean? How it ties in with all the other issues. So let me welcome Jordan Haedtler. He's climate financial strategist with the Sunrise Project and Climate Cabinet. Jordan, can you start putting these dots together for us?
Sure. Thank you for having me and inviting me to speak with this panel. I'd like to focus today on how climate risk and the challenges that it's creating for insurance companies is creating the possibility of another big financial crisis like the one that we experienced in 2008. And the basic facts are that as the costs of extreme weather events from climate risk have grown, insurance has become less available and less affordable. And we are seeing large insurance companies withdraw from climate vulnerable regions entirely and sharply raise premium rates and underpay damages from climate disasters. In a story last year about the shrinking availability of insurance from this problem, the New York Times began with a very starkly straightforward lead, and it said the climate crisis is becoming a financial crisis. And that is a very easy to understand reflection of what many federal financial regulators have cautioned in recent years. Shortly after President Joe Biden took office, the Financial Stability Oversight Council, also known as FSOC, which is a set of federal financial regulators that was created after the 2008 crash, identified climate change as an emerging and increasing threat to financial stability. And ever since then, the regulators who sit on the Financial Stability Oversight Council have warned that insurance can be a major channel for spreading risk throughout the financial system, much like the mortgage-backed securities that created financial contagion and sparked the financial crisis in 2007, 2008. Last year, the Federal Insurance Office issued a report that outlined gaps in insurance regulation, which in the United States is mostly handled by state insurance commissioners. And that report identified problems that are preventing state regulators from properly measuring how and whether the insurance companies that they regulate have sufficient resources to pay out claims in response to climbing costs from climate disasters. In many cases, we don't even have reliable data about how much worse this problem is becoming. But we do have some estimates. For example, the Consumer Federation of America recently estimated that 6.1 million homeowners in the United States lack insurance. And that is a number that is likely to grow sharply as the climate crisis intensifies and insurers spike rates, withdraw from markets, or refuse to renew policies in a wide range of climate vulnerable communities, from Florida and California, which have gotten most of the media attention, to states like Iowa and Minnesota. And already the 6.1 million household figure that the Consumer Federation of America put out represents $1.6 trillion in property values. So since insurance is required by nearly all mortgage issuers, as it gets less available, this will make the housing affordability crisis that we already face in the United States worse. And this problem of uninsurance was cited in a speech last year by Treasury Secretary Janet Yellen when she named what she called the protection gap, which stems from this lack of insurance. More and more people are going without insurance or without enough insurance, and those climate disasters are causing homeowners, businesses, and renters who are underinsured to incur huge costs. And now then faced with rebuilding expenses that they can't possibly afford to pay, households and businesses will have no choice but to walk away from mortgages or other loans that are held by banks. And this means that the costs from climate disasters may spill over into the banking sector and spread throughout the economy. This past week, the United States Senate Budget Committee held a hearing on this topic, and one of the witnesses drew parallels between the housing and insurance markets in Florida right now and the subprime mortgage markets in the period that led up to the 2008 financial crisis. Specifically, the witness cited evidence that credit rating agencies are exaggerating the financial health of small insurers that have recently entered the market in Florida, and the public could potentially be on the hook for mortgages that may have a really high risk of being underwater in the near future. I want to make two final points, and that is, first, this is not just a problem on the coasts. In fact, some of the most dramatic hazards and costs have been from wind and hailstorm events in states like Iowa and Minnesota, not just from hurricanes in Florida or wildfires in California. And this is not just a problem for homeowners. Landlords can and do pass on insurance costs to renters. And of course, this problem in general is making housing markets less affordable and less available. Earlier this year, Jay Powell, the chair of the Federal Reserve, confirmed that insurance prices are driving up housing costs, and he explained that this is a big part of why inflation remains above the Fed's target. So this is really a problem that affects all of us and has enormous implications for the financial system. And with that, I'll turn it back to Pilar.
Thanks, Jordan. I just want to sigh. That 1.6 trillion number in poverty values is very chilling. Can state legislatures do anything? Or Congress? More than they've done?
Yes, the Federal Insurance Office report didn't just outline problems. It also included a number of policy recommendations, most of which can be implemented by state insurance commissioners and by state legislatures. So, for example, they suggested updating the risk-based capital formula that insurance regulators use to incorporate wildfire and other climate risks that are currently excluded. They also suggested adopting scenario analysis so that insurance companies are required to measure what their exposure is to climate risk in a similar way to banks. These suggestions are pretty wonky, but it was a really great report that the Federal Insurance Office put out, and I recommend that folks read it. And the audience really was state policymakers.
Darlene, do we have anything, I mean, thinking about healthcare, right? When we got the ACA, the so-called Obamacare, right? Can we have something like this for homeowners insurance?
Well, there are a few national programs available. The National Flood Insurance Program is a program that is administered federally, and it has many problems, most of which are also related to climate risk, but it is in need of reform and modernization. And there have been people who have suggested that we should create some sort of national backstop for the insurance market. Representative Adam Schiff from California introduced a bill earlier this year called the Insure Act, which replicates another law that was created after September 11th, the Terrorism Risk Insurance Act, that would essentially create a national insurance backstop to address how climate risk is affecting insurance markets.
Thank you for that. Renee, Barbie, do you want to ask your question and identify your media outlet?
Thank you. I'm with La Nueva Voz, and in Southern California, we have lost a few clients who are advertising their insurance rates for fire and other related homeowners insurance. The insurance industry is no longer allowing State Farm and other homeowner insurance companies to give homeowners fire insurance policies. Is that going to remain in effect forever because of all the fires that take place in Southern California?
Well, we do have the California Insurance Commission say about that.
Sorry, I missed, you cut out for a moment, Pilar. I was going to suggest that, yes, this is a problem that is actively under development, and there are major legislative proposals and regulatory proposals being debated in Sacramento right now, and probably the best person to speak to them would be Commissioner Lara.
Okay, so we'll let him speak later on. Okay, let's move on to our third speaker right now, Carol Kousky. She has deep expertise in this issue as well. Welcome, Carol.
Hi, thank you. I'm going to echo a few things that you've heard already, but I want to start by zooming out for a second and summarizing some of the research that documents the important role that insurance plays in recovery to essentially provide some more motivation on why we care so much about insurance availability and affordability. So, for example, a colleague of mine at Freddie Mac and I undertook a survey of survivors of one of 4 U.S. landfalling hurricanes and looked at their financial recovery over time. And what we saw is that those with insurance were much less likely to have unmet needs or high financial burdens in both the short and longer run. And this echoes other research that those with insurance rebuild faster, are more likely to rebuild, have higher self-reports of recovery. There's nice sociology research that lack of insurance can widen income inequality after a disaster. And we've also seen in our research that as more people in a community have disaster insurance, it creates positive economic spillovers. So for example, as more people have flood insurance, after a big flood, you see more visitations to local businesses. So it helps jumpstart the entire economy. And as you already just heard, right, from Jordan, what happens in insurance markets also spills over into housing and mortgage markets. Since you need insurance for a mortgage, when costs go up, the cost of occupancy goes up, which can make some locations unaffordable. We see in research that higher insurance costs get capitalized into home values, so you see lower home values. And again, lack of insurance can set back rebuilding and recovery. So a well-functioning disaster insurance markets provides a lot of important financial benefits for households, for communities, and for the broader housing and mortgage markets. But in this and other work, we also find that disaster insurance is often failing to deliver these financial benefits. And let's talk about why that is. I want to start with some equity issues and then turn to a few more comments on climate, echoing what you've already heard about the climate stress. So in our survey, for example, we found that lower income households are less likely to report finding insurance useful. And that points to affordability challenges that we know exist, but there are other difficulties in the market too. So at EDF, we have an ongoing program of work that we refer to as our inclusive insurance work. And we put out a framework for the US around inclusive insurance, where we define that as the suite of programs, policies, products, approaches that allow for appropriate and affordable insurance protection to be offered to those currently unserved or underserved by the existing market. And we see there's lots of barriers right now in our markets to greater inclusivity. And you've heard a couple of them. There's limitations around disaster coverage. For example, flooding is completely excluded from your homeowner's policy. You have to go buy a separate one from the federal program. There's big affordability.
Slow down a tiny bit because of the interpreters, please.
Sorry. There's big affordability problems. Disaster insurance fundamentally costs more money than non-disaster insurance, and this can put it out of reach for many households. We also see that certain types of post-disaster needs are not well covered by our current types of insurance, particularly emergency needs right after a disaster, and also non-property losses. So things like buying a generator and fuel when the power is out, higher commuting cost when transit is down, temporary lodging because you can't live in your house, those higher rents, those types of losses. And finally, while there's not much evidence of direct discrimination in our property insurance markets, there's lots of indications of unequal impact and procedural inequities when it comes to various aspects of insurance, like getting a fair claim payout. So in that report, which I can share, we talk about a range of policy reforms, both legislative and regulatory, as well as private market innovations that could help solve some of these challenges. Those range from federal means testing for flood insurance discounts to state regulators mandating baseline coverage in homeowners policies, so everyone has a floor of insurance coverage and knows what that is, to processes to reform the claims process to make it easier to get your full and fair payout from your insurance company, to innovative types of insurance like microinsurance or community insurance models. These ongoing equity challenges are even worse in areas of high climate risk. So as you have now heard, climate is increasing the risk, right, of a range of weather-related extremes. That's severe events like hurricanes, but it's also just bad storms and hail and those types of smaller events. And this is stressing insurance companies to a point where it can be impossible for them to offer coverage at a price that people can afford to pay. So you get this breakdown in the market, which we're seeing around the country now, especially in the high climate risk areas, which includes 4 big trends, and Jordan touched on these. Bankruptcies. A dozen insurers in Louisiana went bankrupt in the last few years, Florida too. Escalating prices everywhere, but much higher in areas of high climate risk, like South Florida. Exits from markets where insurers just won't offer coverage at all. And if they don't leave entire states, they're leaving high-risk zip codes or locations, hollowing out the coverage they offer. And all of that means risk is now migrating from the private market into our public sector programs, which is raising fiscal risk for states. So just to end now, stabilizing this stress that we're seeing in insurance markets right now can really only be done through transformative investments in risk reduction. It is the high and ever growing higher risks of climate driving this destabilization in the market right now. And so we need greater climate adaptation.
Thank you, Carolyn. Can you delve a little bit deeper on what risk reduction is for us lay people?
Yeah, so risk reduction is a range of things. It's building stronger. We know how to build homes that can withstand high winds, that can withstand a lot, but not all wildfire risk. For instance, the Institute for Building and Home Safety, IBHS, has standards for hurricane building called Fortified. They also have a wildfire standard. When you build to these standards, your losses are a lot lower and your insurance is lower as well, reflecting that lower risk. But we also need community investments in risk reduction. We need to have a climate lens on our land use and where we allow building, investments in green infrastructure and gray infrastructure to also manage escalating risk. So depending on the particular peril, there's a whole range of things that need to be done, but a lot of it's about building and land use.
Great. Is there anything that people in communities can do themselves? I mean, us, the homeowners, the renters, people who live.
Yeah, depending on the risk, there's a lot you can do for your own home. If you're in a hurricane-prone area, for example, you can upgrade your roof to a fortified standard, which will really lower your losses and your insurance premium. In high fire risk areas, right, there's fire-resistant materials and defensible space. Wildfire is trickier, though, because the wildfire risk, and Commissioner Lara can probably speak more to this, really requires all scales working together. You need to be doing the changes to your home, but you need your neighbors to be doing it too, because fire can spread. And you need the community to be doing it, and you need the forest to be managed in a healthy way as well. You need so we think of it from the household to the community to the backcountry. So wildfire needs, more cooperation.
So there's a lot of different sectors that need to be involved. Thank you, Carolyn. Let's bring in California's Insurance Commissioner, Ricardo Lara. Ricardo, bienvenido. Can you turn on your camera?
Hola, ¿cómo estás?
Hola, ¿qué tal?
Sabes, I'm having computer issues and I cannot turn this camera on.
Oh,
I'm so
no.
sorry. I'm
Oh.
on a new tablet and I can't figure it out, but you can hear me, right?
Yes, we can hear you. Go ahead.
Okay, thank
So
you.
what's going on in California? What are you
Oh
guys?
my God, what is not going on in California? Carolyn, I mean, I want to take Carolyn on a roadshow with me. She's so good at talking about just the different challenges that we've been facing. And let me be clear, California has an insurance crisis like nothing we've seen before. And we need serious reforms and innovation, as Carolyn was talking about. And we know that it's harder to find insurance, especially if you are at a higher risk from climate change, to the point where some people cannot find insurance at any price. And when I was listening to Carolyn, it reminded me of the fact that, as cities build out, as cities evolve, discrimination is done by design and by we put our lowest income folks in floodplains, in wildfire areas. And so something's very clear that in California and globally, because this is really a global phenomenon now, insurance cannot be an afterthought when we talk about where we build, how we build, and in the overall conversation around climate. Because without insurance, you can't do anything. And so we have, and to that end, we also have a big opportunity to fix this crisis. And this is why in California, I'm doing the largest reform in more than 30 years. And as you've heard, we are also seeing, as I say, this is nationally and global in nature. I was just meeting with a group of South American insurance regulators, or superintendentes de seguros, and they're having the exact conversations. Why are we still building on the coast with sea level rise? How do we handle building code upgrades for earthquakes and wildfires? And so, this is why it's critical that we're having these conversations and that our journalists engage in these issues like insurance. And I know it could be tedious and could be a little difficult to understand, but we're all learning together, right? And why your voice is critical, because you represent some of our most affected communities. And so it's really great to be here. I'm going to talk a little bit about my strategy and then kind of give you some perspective on what we're doing. And my strategy is really addressing decades long of neglected issues. And I understand I am in this position now. I own this problem and I'm going to fix it. And this is what is happening. Unlike public and private utilities, insurance companies are not legally obligated to provide coverage to anyone. That is a limit of Prop 103, and the problem my strategy is trying to fix. And we've been operating, as some of a lot of the other speakers mentioned, we essentially have been operating with 20th century regulation for a 21st century world where climate change is affecting every aspect of our lives. And our rules were written in the age of papers and payphones that don't account for this current situation that we're living in. So my sustainable insurance strategy is what we're calling it, will strengthen insurers' commissioners' authority to protect consumers and hold insurance companies to task. This is a comprehensive approach that includes improving the rate review process so that we have the complete data our experts need to fully protect consumers. Utilizing forward-looking tools to access and price risk like those used by every other state except California. Not just looking, we cannot just look to the past to set our rates. We know climate is changing everything, and we cannot be using historical data to tell us where we're going to be most at risk or how we price. Improving the California FAIR Plan, which the FAIR Plan is our insurer of last resort, so that it has the coverage options people need while our changes take effect. And we are on track to implement all the changes by December 2024. So insurance companies start writing more policies in all these areas. The insurance companies have committed after our reforms that they are gonna commit to write 85% in these communities that have been abandoned, and that is a big historic deal. And I recognize the urgency of what we're all going through, and we have to balance getting public input and priority transparency and having conversations with the industry, because as the insurance commissioner, my job is twofold. I need to make sure that consumers are protected and that insurance companies remain solvent during this crisis. Because as Carolyn said, nobody wants an insurance company to lose solvency, and then consumers are the ones that ultimately get hurt. And so we're making progress. Our entire team has been continuously engaged and working hard throughout this insurance crisis. And let me tell you about some of the results that we're already seeing. Farmers Insurance announced that it would reopen several of its commercial coverage lines, including for homeowners associations, apartments, and condominiums. This matters, especially because our farmers, our agricultural industry it needs this coverage as well, because they've been losing it. But also Farmers is the insurance company based in California and is the second largest homeowners writer. Mercury Insurance is working with Tokyo Marine to pick up the bulk of its personal homeowners insurance business. And Mercury is another California-based company that has not stopped writing new homeowners policy, and Tokyo Marine continues to write commercial. In April, an Allstate executive testified and saying that it will end its pause to new homeowners business in California and begin writing in every corner of the state when our strategy is implemented. And this week my department authorized State Farm to offer a difference in condition policy. So it's non-renewed policyholders, as you saw in the press, who have to go to the FAIR Plan, have some more options. And so a comprehensive policy is really the best choice for homeowners And the FAIR Plan needs to be the last resort, and it has to remain that. It cannot be the first option for Californians, as we've been seeing that the last few years. And my department obviously can always help you so that you don't have to settle. You know, as much was talked about climate, and I'll tell you that as climate impacts accelerate, insurance protection gaps are leaving more and more people, households and businesses vulnerable, as you already heard. We know that a lot of the people do not have coverage they need, especially in our immigrant communities, or are severely underinsured. Only 2% of Californians have a coverage for flooding, but flood disasters have happened in every single county over the past 30 years. We saw that when Pájaro and Planada were hit hard by winter storms. On wildfires, data shows that half of the FAIR Plan policyholders do not have a difference in condition policy, leaving them without protection for storm damage, broken pipes, liability, and other common losses. So this is clear. This is a clear insurance gap that needs to close quickly. And so we've been working on climate policy for over a decade. During my time in the legislature, as many as you know, the communities in Southeast Los Angeles, I established some rules and incentives for reducing emissions that obviously contribute to global warming. I'm now working with advocates, like you heard Ricardo, with EDF to create a new climate insurance approach. And let me be clear, climate insurance is not anything new you need to buy. It is a way for local communities to work together to make themselves safer and build back quickly. Part of the climate insurance is about strengthening our natural defenses against extreme heat, flooding, wildfires, including our wetlands and urban forests. We know it is much less expensive to prevent damage than to have to fix it after a disaster. So a local community could actually take out an insurance policy on a wetland, for example, and restore it quickly if it is damaged. This is groundbreaking and has never been done before in the US. And we want to do it here in California first. Governments, again, are increasing their focus on safer communities. California has made record budget investments in wildfire safety. US regulators are stepping up. And in March, we actually adopted our first ever national climate resiliency strategy for insurance. Never been done before. We got that done in March. This is an action plan for insurance regulators to advocate for home hardening from wildfires. As Pilar was saying, you know, what do we need to do? We need to harden our home from wildfires, floods, and storms, and put in place new tools to keep insurance available for all. This strategy really builds on some of the insurance sector's most important risk mitigation programs. And there are several successful programs now: Alabama, Minnesota, Colorado, and of course, our Safer from Wildfires regulation here in California. And Congress also needs to do its part. Last month, I urged our members of Congress to support our work. There are things Congress can do right now that will help our insurance crisis, and they can do this in a bipartisan way. The first is we need better management of our federal forests and watersheds. Because of decades of neglect, federal forests are overly dense and vulnerable to severe wildfires. And, you know, I was shocked to hear this number. 58% of California's forest is under federal control. So Congress can implement recommendations from the Wildfire Commission under the bipartisan infrastructure law, for example. The second is increase funding for home hardening and community grants. This is essential to make communities safer. This would help increase the discounts for consumers we are requiring under regulation that I created a couple years ago called Safer from Wildfires. And third is changes to the federal tax code. This would enhance the impact of state risk mitigations so that we can get there faster. And finally, you know, they can support our sustainable insurance strategy for California. And just in closing, what consumers can do today. Right now, it's not enough enough to just shop for insurance. You have to hunt for it. And we need to hear from you. So if you're having issues, my department is, you know, we have insurance experts available, and we speak multiple languages, and whatever language you feel comfortable in, And my department can help you scour the market for insurance. So we urge consumers to call us at 1-800-927-4357. That's 1-800-927-4357, or visit us at insurance.ca.gov, where you can email us, or you can even use our online chat feature. If you have a question, you can jot it down, send it, and we'll return it. We'll return it to you. We'll return an answer to you quickly through this live chat. So, you know, we are all coming together to address this global crisis, but we know that in California in particular, given that is the largest insurance market in the country, we're feeling it much more acutely here. And so again, Pilar, thank you so much for allowing us to be here today and geek out about insurance.
Thank you. Can you take a couple questions, Commissioner?
Yes.
And sad that I could not see your face. Not having a camera, I only see you on Facebook. Okay, so VG, you have an interesting question. Do you want to ask your question? VG Sundaram. What media are you with? VG?
Yeah,
are you on?
Sorry, I wasn't unmuted.
Okay.
My question.
What's your media outlet?
Sorry?
What's your media
outlet?
Yes.
I write for the San Francisco Public Press.
Excellent.
My question to the Commissioner Lara is this. Hi, Commissioner Lara. I haven't seen you in a long time. Since I left.
You're not seeing him now.
America Media. But anyway, my question to you is this. I can understand climate change impacting homeowners insurance. Why is it that auto insurance is going up and away?
Yes, that's a great question. And what we saw during, for example, during the pandemic, when I forced insurance companies to give discounts back to folks because they weren't driving as much. We wanted them to stay home, and they were still paying the same rate as if they were driving. And so we did that. What we quickly saw after the pandemic, a couple things. The bodily accidents skyrocketed. The risk of driving a car in California went extremely high, coupled with inflation and the cost to repair vehicles and the cost to obtain parts skyrocketed as well, as we were having issues at the ports and with inflation. So all this, again, which by the way, is all coupled, and also it has trickled down to the homeowners market because the cost for materials is so high right now, and there's not enough labor to actually do the work. And this is also the case for auto repair. So one, people started driving much more reckless, and you see the numbers skyrocket. So that increased the risk. Also, the cost to repair the vehicle and the lack of workforce to actually do the repairs is all contributing to the high cost of insurance, and to the availability and affordability of auto insurance as well.
Thank you.
Okay, thank you very much. So we have about 10 minutes. I want to go around the panel again, and ask a slightly different question to all of you. Polls show that voter interest in climate change is very low. So of course, interest in the economy is very high. So if these two are so connected, and part of the way we want the public to know this is by doing events like this, what else would you suggest we can do as ethnic media reporters to really illustrate the financial consequences of climate change? Let's go around the panel. Vicky, you want to say something about this?
Well, I would second Carolyn's reference to IBHS. Seen a presentation by one of their researchers on, for example, the differences in a home that has had the protections for wildfire versus a home that is not. It's like they have video of some of their test materials, which are just striking. So I think more exposure to the types of steps that homeowners can take, I think would be important. And I think as you suggested, the connection between the economy and climate is something that I think people will not have the luxury of ignoring a whole lot longer, but I think insurance is definitely one of those mechanisms that is putting it front and center right now. And people are asking the questions, what's going on with my insurance premium? And I think as forums like this, where they're provided with some of those answers, I think are very important.
Yeah, it's becoming, and it has become a pocketbook issue. Jordan?
Well, so many of the financial stability issues that I work on around banking and insurance regulation are very dry and not particularly appealing to the public until a
Yeah.
massive crisis happens. And a lot of the polling that we've done as we've advocated for the establishment of a climate financial regulatory framework, has shown that voters very well remember the 2008 crash and its aftermath, and that drawing parallels, as the witness at the Senate Budget Committee hearing did earlier this week, can really make voters aware of what the implications are for financial instability. And we're seeing really that this is a major way, arguably the primary way, that climate change is becoming a pocketbook issue. And you don't have to wait for a crisis moment to see that. There was a special election in Florida in January of this year, and insurance was the key issue that enabled Democrats to pick up a seat that Ron DeSantis had carried by 12 points. It's a huge voting issue, and it's in most states, insurance commissioners are appointed, but in states like California, Commissioner Lara is elected, and we're seeing a few insurance commissioner races on the ballot. I'm going to be watching North Carolina's insurance commissioner race. I think that's going to be very competitive in a swing state, and it's because of a lot of the climate risk challenges that are affecting North Carolina's market as well, as they brace for a very intense hurricane season. So I expect that this will be a major way that the political salience of climate and the economy grows in the years to come.
Thank you, Jordan. Carolyn?
Yeah, it's an interesting question. I've been at times frustrated that I think many people don't draw the connection between these economic impacts and the need for actual climate policy. And it is incredibly, I think we've progressed a lot in having the important conversations around risk reduction and climate adaptation that have to be on the table, but I think we are not doing so great, with the exception of California and Commissioner Lara's leadership, I will put in, and making the links to the broader climate policy that's needed to make sure that we don't, continue to get us into catastrophic levels of risk. I mean, we already are very high levels of risk from climate. So, and I think part of it is, it might be interesting at some point to do something like this with some behavioral economists and psychologists to talk about how, we think about these issues and some of the difficulties in motivating broader climate action. But I'll just end by saying, and maybe this is sort of echoing Jordan a little bit and teeing up the commissioner, that there seems to be enormous heterogeneity across the country depending on local politics. And so it's been incredibly hopeful to me to see what California and Commissioner Lara have been doing to get ahead of some of these really scary risk issues.
That's good to know. Commissioner?
Thank you. As I thought about your question, I'm living this real time with we've had town halls in every county in the state. And as you can imagine, people are scared, they're frustrated when they're losing insurance, and people don't think about insurance until they actually need it. And so we have challenged ourselves internally. How do we make insurance more understandable for consumers? How do we get rid of all this legal jargon that is necessary during you purchasing a product, how do we simplify that for our immigrant community, for our just people in general? And so we're looking internally in our department at how do we make this more consumer friendly, but we're also not losing the opportunity during this insurance crisis to talk about the important work that state regulators can do around innovation, around regulatory reforms, and modernizing our departments so that we are able to meet this moment. Insurance, I don't think, has ever been at the forefront like it has. And so I tell my team, look, all eyes on us now. And so we have to deliver during this moment. The conversations for the consumer, as I've talked to them, you can imagine people are scared and really angry when they meet with us. But when you sit down and have a conversation about how climate is disrupting every part of our life, health, where we live, every aspect. And so we make that connection to them and then attribute the fact that it is risky to live in California. It is a beautiful place, but all you got to do is look at we just had an earthquake in Southern California. So there's a price to that. And we all have to come together and figure out how do we bring down the risk. And I'll tell you, Pilar, when we're done after a couple hours, they understand. And they're like, okay, so how do we work to bring down the risk for our communities? We don't want to move. We want to make our homes safer. The other challenge is that this costs money, right? And so how do we work with the federal government, with state legislatures, with the nonprofit community to help figure out how do we fund some of these home hardening programs? Because if you can imagine, one, it costs to buy the material. Then you have to pay somebody to actually do it for you. What about if you're retired? What about if you're a community that was somebody who's been pushed out of the urban core and into our most environmentally vulnerable communities, right? And so it all has to be integrated. And this is why I keep saying insurance can no longer be an afterthought. In local governments, when they're looking at planning, when they're looking at future developments, insurance can no longer be an afterthought in the global discussions around climate, because it is paramount to be able to access insurance to do a lot of the work that we're doing. And so it behooves all of us. And so this is why roundtables like this are important, meeting consumers directly. When I started in 2019, people thought the Department of Insurance, that we were only represented insurance companies because we're the Department of Insurance. So even that, right? So we have to do the old school ground political organizing and talking to voters. And so that's what we've been doing, and we need to do more of it.
Thank you. Thank you, Commissioner. Thank you, everyone, for being here. And it's not just on the Commissioner, it's also on us in the media, especially us who represent ethnic media in different communities and languages, to bring this information out to them. And I'm happy that we have so many of our reporters join us. Thank you very much to everyone, and we'll see you next week.